In today's video, we're going to talk about a specific number that you need to be focusing on to make better retirement tax decisions. Most people commonly focus on the wrong number, and hopefully we can help correct that today. To start out this conversation, I want to go over two key tax figures that are often used to make decisions both while working but also in retirement. First, we have something called the effective tax rate. This is a summary statistic that tells you how much of your income you pay to taxes in a given year. And figuring out this number is quite simple. You take the total tax that you owed in for the year and divide it by the gross income that you earned or took from your accounts in a given year. So on the screen, I have an example of a single filer that earned $120,000 at their job during a calendar year. Based on 2025 taxes, this person would owe just over $18,000 in income taxes, which translates to an effective tax rate just over 15%. In my anecdotal experience, most people use this effective tax rate number to make most decisions in retirement. At the end of the year, if their effective tax rate is low enough, whatever that means to that individual, then they are happy. In fact, if it's low enough, they may even decide to do things like Roth conversions in order to raise that effective tax rate a little bit, because the idea here is they can afford to pay a little bit more in taxes to avoid future taxes. Unfortunately, using effective tax rate to make tax decisions ironically is quite ineffective. Marginal tax rate, as the name describes, is a number that looks at a specific dollar amount of income and then assesses the tax you paid on that specific income. For instance, at $120,000, this person's top tax bracket was the 24% tax bracket. So on the last $1,000 this person earned, this person paid in $240 in taxes, or 24%. The key thing here is marginal tax rate doesn't just look at $1,000 of income earned, but can also be looked at in the context of the next 1,000 you earn or the next 10,000 you earn. It simply explains the tax rate on a specific step of income. Throughout your financial life, you will be forced to make a lot of decisions, like which account you should contribute in saving for retirement, or which account you should withdraw from in retirement, or whether or not you should perform something like a Roth conversion. When making any of these decisions, as I've already said, effective tax rate is quite ineffective. Instead, your focus should be all on marginal tax rates. Marginal tax rate is what gives you clear decision-making power, and let me show why. While working, you don't really have that many options to strategically keep your tax bill lower. You more or less earn the income you earn and pay taxes on that income. Yes, you have some optionality in terms of deciding to save into pre-tax accounts or Roth accounts, and that decision affects how much gross income is actually taxable. But for the most part, you have one source of income, and that's working income taxed at ordinary income rates. When retired, however, you have a lot more options. Options give you power to be strategic. Social Security is an income source that most retirees have and is taxed on a sliding scale from your Social Security benefit being all the way from tax-free all the way to 85% of your benefit being taxable. Where you take income from determines where you fall on that sliding scale. Withdrawals from traditional IRAs are taxed similar to working income, where you are subject to ordinary income rates. But then we have options like a Roth account, where you could pull unlimited funds from this account and avoid taxes entirely. There are also capital gains and dividends, which are taxed at lower rates if they are long-term capital gains and qualified dividends. Things are a lot more a la carte in retirement, where you can fill your income need any way you want, assuming that you have the funds to do so. While making all of the tax decisions that I talked about earlier comes down to marginal tax rates. Let me explain why with a simple Roth conversion example. A Roth conversion is a strategy where you take money from a pre-tax account like a traditional IRA, pay taxes on that money today in order to convert it to a Roth IRA, and obviously never pay taxes again. When we talk about decision making around Roth IRAs and pre-tax accounts, everything comes down to marginal tax rates that you pay. What tax rate are you paying on the Roth conversion versus what tax rate would you otherwise be paying on a withdrawal if you didn't convert? If the tax rate you pay on conversions is lower, then a Roth conversion would be beneficial. If it's higher, then you actually wouldn't want to Roth convert. The example on the screen shows this. In this example, we are using the same tax rate on both the Roth conversion, but also on the pre-tax withdrawals. We are growing both accounts at 7% per year, and as you can see, these are equivalent situations because the tax rate is the same, as well as obviously the growth rate. Sure, without a conversion, you have a bit more in your pre-tax accounts, but you have to withdraw more annually to end up with the same $8,000 of net income each and every year. In the end, both scenarios converge to the same result. The same math applies if we are considering whether to contribute to a Roth account or a pre-tax account. A pre-tax account gives you a tax deduction a day. So again, we would compare marginal tax rates to decide which account is better for your situation. If the marginal tax rate on the last dollars of income are 24%, and you believe you can withdraw this money in retirement at rates cheaper than 24%, then you should take the tax deduction today and contribute to that pre-tax account. If you already have a ton of pre-tax dollars, and because of future RMDs and whatnot, pre-tax dollars means you are likely withdrawing the money out at rates higher than 24%, you should opt to contribute to Roth. It all comes down to the marginal tax rates. Now, while working, as I said before, you don't have as many options. You are subject to ordinary income tax rates like the ones shown on the screen. Marginal tax rates are typically simple to find here. However, in retirement, your tax chart can change a lot and open up marginal tax rates that most retirees probably don't expect. For instance, here's an individual taking Social Security that has $35,000 in Social Security benefits. They also have a taxable account that's generating $18,000 in long-term capital gains and dividends. Before this person takes any other withdrawals to fill up their needs for the year, this is what their tax chart looks like. The x-axis shows incremental income this person could take, and the y-axis shows the marginal rate that they would pay on said income. As you can see from the chart, there are a lot of tax hurdles this retiree will have to wade through. In blue, we can see the normal ordinary income tax rates, but then in purple, we see an add-on tax that is triggered by Social Security becoming more taxable. Again, remember Social Security is a sliding scale as we mentioned before. In red, we see another hurdle this retiree will face. As they take more income, their dividends will go from being taxed at 0% to 15%, which creates another hurdle. Now, shortly after these hurdles end, this retiree will have to worry about Medicare's IRMA, which is an add-on expense to Medicare for showing too much income. I have videos that I'll link to that'll explain some of these tax traps more in depth in the description down below. But I've labeled in red all of the marginal tax rates this retiree may pay that are higher than probably what this retiree thinks they are being taxed at. Going back to what we've already covered, this is why marginal rates are so important. Most people contribute a bunch to pre-tax accounts thinking taxes will be lower in retirement, only to find out that there are multiple times marginal tax rates are actually higher in retirement. It's the effective tax rate that is often lower because you have income sources that are tax preferred or not even taxed at all. But it really doesn't matter what the effective tax rate is. In making the best decisions on something like which account to withdraw from, you withdraw from your IRA based on marginal rates. You contribute to your IRA based on marginal rates. You perform Roth conversions based on marginal rates. If we want to lower our tax liabilities in retirement, we need to focus our energy on keeping marginal rates low now, but also in the future. Let me give you another example where marginal rates matter, expanding this example a little bit further. So this is a 70-year-old individual with the same Social Security benefit and dividend income as shown before. But to fill in the rest of this person's income need in retirement, they're going to pull $65,000 from their pre-tax IRAs. Well, if we just look at this from a summary standpoint, this individual might be pretty comfortable with their tax situation. Total taxes owed are just under $15,000, which gives this person a 15.5% effective tax rate. Again, many might view this as a satisfactory rate to pay. However, let's dig a little bit deeper. We mentioned IRMA before. This is a Medicare penalty for showing too much income. Effectively, you end up owing more for Part B and Part D of Medicare. IRMA is a tax cliff, where you have a full penalty if you go over a threshold amount, whether it's $1,000 over or $10,000 over. IRMA also has a 2-year look back, so the income shown in 2025 affects what you pay for Medicare in 2027. This individual's modified adjusted gross income came in at $113,000, which is $3,000 over the assumed threshold zone. Because they fell over this IRMA cliff, they will see their Medicare expenses rise about $91 per month, which totals over $1,000 for the year. So breaking down the last $3,000 of income this person took from their IRA, they paid in $660 in taxes based on a 22% tax rate, but they also owed an extra $1,000 for Medicare, which brings up their total taxes or costs to $1,750. They paid a 58.5% marginal tax on the last $3,000 of income, which is extremely high for anyone. Had this individual known this ahead of time, they would have instead opted to take the last few $1,000s from their Roth rather than their IRA and avoid IRMA entirely. But effective tax rate would never clue this retiree into this situation. It's only by focusing on marginal tax rate that we gain any decision-making power here. And what's interesting is that in most areas of life, we actually do think in marginal terms, but for some reason this doesn't always translate to tax planning. For instance, say you are on a diet and you have 2,000 calories that you can consume in a given day. To be effective with this diet, most people don't just aimlessly eat and then stop eating once they've reached that 2,000 calorie limit. You might aimlessly eat a donut for breakfast, a morning snack, and then a big burger for lunch, and holy crap, you're already at 2,000 calories and don't get to eat anything else the rest of the day. Instead, you look at individual foods, like in the morning, compare eating a banana or apple to a donut and go, well, crap, that banana and apple are a fraction of the calories, more nutritious, so let's opt for the better marginal choice to leave more room for later. The same premise applies in tax planning. It all comes down to marginal costs and decisions. Now, hopefully this video helped increase your understanding around how to strategically tax plan in retirement. If you're interested in learning more about major tax hurdles that you will face in retirement, click on this video right here, where I talk about 9 common tax traps retirees will face. Click on this video to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.